Welcome, everyone. My name is Himani Fadke, and I'm Research Director at the Sustainability Accounting Standards Board, SASB for short. I will be moderating today's webinar, which is titled, What Story is Your Sustainability Information Telling Investors? Before we start, if you have any questions, you can type that into the questions panel. And I wanted to clarify that we will be sharing the presentation deck after the webinar, and this webinar will be recorded as well, so we'll post it online and send you an email with all that information. The webinar today will focus on the evolving field of ESG, or environmental, social, and governance disclosure and analysis, and the type of information that investors are looking for from companies. I'm joined by SASB's Brian Esterly, who's sector analyst for the electric utilities industry, and MSCI's Guillaume Mascotto, who is the lead analyst for the utilities sector and the electrical equipment industry for the MSCI ESG research team. Guillaume and Brian will use the electric utilities industry as a case study to discuss how certain ESG issues can impact financial performance, and also they'll talk about the importance of high-quality disclosure on a limited and targeted set of metrics. I'll give you a quick introduction to Guillaume and Brian's backgrounds, and then we can begin with their presentations. So prior to MSCI, Guillaume was a project manager at Resolute Forest Products, and he was responsible for managing the company's financial and non-financial reporting process. Guillaume also worked as a market entry strategy consultant at CB&I NV, where he advised executive management on oil and gas investment opportunities in the Caspian Sea region. He holds an MALD in International Business and Economics from Tufts University. Brian at SASB holds a CFA, and prior to SASB, he worked in the financial risk management industry, most recently serving as Vice President with Aon's Financial Services Group. So with that, I'll hand over to Guillaume to present his slides on MSCI's work on electric utilities. Guillaume will talk for about 15 minutes, followed by Brian, and then we'll open it up for questions from the broader audience. Guillaume?
Great. Thanks very much, Himani. Hi, everyone. First of all, thanks to SASB for organizing the webinar and for affording us the chance to participate in it. Let me begin with a quick introduction of MSCI ESG research. So as some of you may know, MSCI ESG Research is a global provider of ESG research. We work with 47 of the top 50 global asset managers, and we have over 900 clients. Our staff is truly global and multilingual, and we do have particular experience when it comes to assessing data across different regions. Could we go to the next slide, please? Thank you. In terms of our product offering, MSCI creates tools designed to help institutional investors to understand how ESG factors can impact companies' long-term risk and return profile, and also integrate these factors into their investment processes. Our clients use our products for ESG integration purposes, screening, whether positive or negative, as well as impact investing. But for the purposes of this call, I will focus on the integration front, more specifically on our ESG ratings core product, which is designed to help investors understand material ESG-driven risk and opportunities and integrate these factors into their portfolio construction and management process. Next slide, please. I would also like to take the opportunity to highlight that MSCI ESG is part of MSCI, which is a global index and investment tool provider, and as such, our data ratings are also used in the construction of MSCI indexes, which are designed to help institutional investors more effectively benchmark ESG investment performance. Next slide, please. And next slide, please. All right, thank you. So to begin with, I'd like to go over some of the key industry trends that are affecting the utility sector in order to put into context the various ESG key issues that MSCI identified as having potential material impact on companies. That is both from a risk and opportunity standpoint. So in the interest of time, however, I will focus on just a few of them, but I'm more than happy to circle back on this slide should there be any questions. So let's take carbon regulations. As you may know, such regulations and recent policy developments around the world, including the recent Paris Agreement, constitute a strong catalyst for the dynamics of the decarbonization of power supply. And as they continue to evolve, these regulations will play a role in redefining the utility sector's business model that is specifically in the developed markets. Moving on to natural gas now, you're no doubt aware that the fracking revolution, so to speak, in the U.S. led to a large increase in natural gas production over the past 10-15 years, which helped position gas as the lead transitional fuel in the U.S. With lower gas prices as well as increased capacity factors to the detriment of coal. Finally, let's take renewables, which are continuing to put pressure on conventional generation. For the first time ever, renewables made up half of all new power capacity in 2015. And at the same time, wind alone has already become cheaper than coal and gas in many places. I think Germany is a good case in point here. In all, renewables provided around 22% of the world's electricity in 2015. And as a result of the continuous adoption of renewables, capacity factors for fossil fuels are declining. And this is because once solar or wind projects are completed, the marginal cost of the electricity it produces is essentially zero. This is dubbed the free electricity concept. Therefore, as more renewables are installed and provided that power storage is scaled up, coal-fired power plants are used less. And as coal is used less, the cost of running these plants to generate power will rise as renewables gain in cost competitiveness. And this is what we call the renewable energy disruptive cycle. But what do all these trends have in common? Well, they're all affecting the sector at the economic, operational, financial, and competitive levels. In turn, well, this begs the question of how do we all of the data that underpins these sector trends in a scalable and consistent fashion, and more importantly, how can investors best use this data in their investment processes? So on the next slide, let's look at how MSCI ESG ratings can help with that. So to generate our ratings, MSCI focuses on thousands of data points across 37 industry-specific issues, which reflect both sustainability megatrends as well as key industry market trends. And these issues are weighted based on an industry-specific impact with respect to an issue and the time horizon of the risk and opportunity the issue in question may represent. And in the case of the utility sector, carbon emissions intensity is an example of impact. As we can see from the chart here, out of the 37 key issues identified by our research, we've isolated 8 specific that are specific to the utility sectors, including carbon emissions and renewable energy, which will be the focus of our discussion today. Yeah, so Imani, I think if you can click on a couple of, we can see the various issues that we've identified. Yeah, so next slide, please. Thank you. But before we move into examples of how we analyze data with respect to these issues, an important point I'd like to make is that our ratings model is not dependent on company ESG disclosure. In fact, half of our model is based on financial data, specifically asset data or revenue data. And as we can see from the balance scale here, by focusing on both the company's exposure to risks and opportunities created by ESG factors, such as GHG emission regulations, as well as the company's corresponding managerial capacity and performance, such as GHG emission intensities, well, our model allows for the adjustment of the required management strengths in the face of a particular risk. As such, our model, if you will, does not penalize companies with minimal management strategies or performance data if they face low or minimal exposure to a specific risk. And to illustrate this distinction, we're going to look at a few examples on the next slide. Thank you. So here we have an example of how we benchmark companies on the carbon emission key issue. We can see that some companies like NextEra and Southern, both operating in the U.S., have similar risk exposures, but different risk management capabilities. And this logic also works the other way around. For example, if you take RWE and Ross Hydro, well, both have similar management capabilities, but different risk exposures. In the case of RWE, the company is more exposed as a result of its operational presence in Europe and also its coal-heavy fuel mix. But the key idea here is to show that management performance is assessed in the context of risk exposure. And to further illustrate this, we're going to look more deeply into how MSCI uses data to come up with risk exposure assessments, and we're going to continue with carbon emission as an example. Next slide, please. Thank you. So here, as we discussed earlier, we measure risk exposure based on both business and market risks. And in the case of utilities, market risks include current or evolving carbon or air toxic emissions regulations, that is, which are increasingly gaining social and regulatory purchase. In fact, many markets, as we can see from the slide, such as the US, China, and the European Union, have been adopting ever more stringent regulations, which could potentially expose power producers to rising compliance costs, whether in terms of increased capex for emissions control, fuel mix diversification, or asset retirement. Let's go to the next slide, please. Thank you. A company's risk exposure to carbon regulation, however, may differ depending on the carbon intensity of its assets. And as we can see from the charts here, some utilities that are dependent on carbon-intensive energy sources like coal may face less risks of increased costs linked to carbon regulations than peers with similar energy portfolios, but whose operations are located in regions where regulations or GHG limitations are more stringent. And if we go to the next slide. Thank you. We can see that while some utilities may have exposure to carbon-intensive energy sources like coal, they may also have strong management programs that are backed by best-in-class carbon intensities normalized by power generation due to their balanced energy portfolios. And the chart here provides an example of a benchmark of utilities in the MSCI All-Country World Index, focusing on their 3-year average GHG emissions intensity normalized by power generation and the corresponding trends. Next slide, please. So now moving on to the second key issue that we wanted to highlight, which is clean energy. An important distinction here is that clean energy within our model is assessed as an opportunity. We, of course, look at financial inputs such as debt coverage, as well as potential limitations on cost recovery mechanisms as risk factors, but that will depend on companies. The idea here is that the primary data point that we will use to measure performance in terms of opportunities to renewable energy is renewable energy capacity, both current and planned capacity. We're also going to look at companies' investment in smart grid applications and in the integration of renewable energy onto the grid. But, going back to the trends that we highlighted before, and as we can see from the leftmost chart here, if we look at capacity in the context of the intermittence of wind and solar, our analysis of company fuel mix data in the MSCI All-Country World Index show that dispatchable fossil fuel generation actually continues to be the primary option for utilities to meet anticipated demand growth in emerging markets, as well as to sustain peak demand periods in developed markets. That is why one of our theses with respect to renewable is that while renewable energy sources will continue to pressure conventional generation margins, of course provided that subsidies are maintained and that investor confidence is kept, it will still take some time, we think around 5 to 8 years before these sources start to chip away the traditional power generation business model. I'm conscious of time, so on that note, I think there are 3 key takeaways from the presentation. The first one is that energy supply decarbonization, as well as changing power use patterns and technological innovation are slowly redefining the utilities business model. And these factors are primarily extra-financial, which means that traditional financial data analysis will need to be supplemented by ESG data to shed some light on how utilities will be impacted. Second, the rapid progression of ESG integration has increased investor demand for ESG data and tools that can provide context and scalability. And as such, our ratings products, our MSCI ESG ratings, provides a scalable framework of analysis that can help investors optimize long-term ESG risk-adjusted return. So thanks everyone for your time and attention. Brian, the floor is yours.
Thanks, Guillaume. That was really interesting as to how MSCI uses this type of information. I'll hand over to Brian now to discuss SASB's work in relation to electric utilities and across our 79 industries in general. Brian?
Thank you, Humani, and Guillaume, thank you again to you and to MSCI for participating on this webinar. Fantastic information and great review of using the electric utilities industry and a couple of these key issues related to carbon intensity, renewables, and evolving business models to highlight the use of this type of information in investment analysis and investment insights that can be gained through analysis of ESG information. So with that said, once again, my name is Brian Esterly, and I'm going to jump right in and continue the discussion forward, focusing on the electric utilities industry. After that, I'll take a step back and provide a bit more of an overview of SASB overall, but I really want to continue the discussion forward for now, focusing on the electric utilities industry. This slide you see here provides SASB's framework, how we approach every single issue in analyzing the key sustainability issues that are most likely to be material to that industry on an industry-specific basis, of course. And so in the utilities industry, we focused on these 10 general categories. Diving in a bit more detail, we can see the specific sustainability issues that are included in the SASB standards on the right. The majority of the issues relate to the environment, and some of the other high-level categories are in the chart on the left. Similar to Guillaume, I'm going to focus on two key issues. The first at the top is greenhouse gas emissions. And then secondly, I will talk on an issue in our standards called end-use efficiency and demand. But before we dive into both of these issues, let's take a step back and look at the disclosure landscape of all 10 of these issues across the industry. So to do that, SASB analyzes the current state of 10K disclosures for every single industry and every issue included within the SASB standards. This provides the results of that analysis in terms of the 10K disclosures among these 10 issues in the SASB standards. So what we find is that about 86% of the time companies are already disclosing on all 10 of these, or on 10 of these sustainability issues. To us, this reaffirms the importance and management's view of the likely materiality of these 10 issues included in the SASB standards. A bit more, kind of breaking this down a bit further, these disclosures can be considered boilerplate in nature about 26% of the time, meaning they're qualitative and very high level. About 33% of the time they have a bit more specificity, and then 44% of the time they're actual performance metrics that are included in 10K disclosures. So once again, looking at these 10 issues and the state of disclosure across them, we will focus on greenhouse gas emissions first. So in analyzing the state of 10K disclosures on this topic of greenhouse gas emissions, we find that 100% of companies do provide 10K disclosures. This should be unsurprising. It simply reaffirms the importance, the level of magnitude of GHG emissions in the industry overall. Breaking this down a bit further, we find that 75% of these 10K disclosures provide actual performance metrics. But let's dive into these metrics that are provided a bit more. So what we find when we focus on the metrics disclosed in 10K is that there's a wide variety of the actual metrics communicated. In other words, there's no industry consensus, or there's not standardization of what exactly should be reported. And so once again, of the 75% of corporate disclosures that do include metrics, about 27% of the time, there is no metric that is specifically focused on direct greenhouse gas emissions, or scope 1. With another 40% of these disclosures, there are significant challenges to the usefulness of this information. And by way of example, what I mean by that is it could be the prior year's data, it could be an estimate of emissions, it could be variations in methodology, or the scope of coverage. So once again, between actually lacking quantitative metrics on direct greenhouse gas emissions, or in the wide variety of how such metrics are calculated, or the scope and methodology of them, we find significant challenges in the data availability and the quality of this data in 10Ks. So looking at this issue just from another perspective, about 44% of the time overall, there's no disclosure of direct greenhouse gas emissions in the 10K, and 75% of the time there are these types of significant usefulness challenges. So with about 25% of the industry, there is this relatively high quality standardized disclosure of scope 1 or direct greenhouse gas emissions. But of course, to make greater use of that information, what we really need is further standardization or further consensus occurring across the industry. So I think another really important component of this is that direct greenhouse gas emissions is one starting point for analysis of this issue. There's an enormous amount of contextual information, the regulations, or as Guillaume was discussing, the management strategy and how the company is evolving and the risks or opportunities confronted by this issue. So there's opportunity for further quantification and further description or standardization of how companies are performing in managing this information, or the greater contextual information around this issue. I want to now take a moment and talk about disclosure and voluntary sustainability reports. Largely a result of this chart that we see here on this slide and the challenges confronted by using 10K disclosures in analysis of this issue, it should be unsurprising that investors and analysts are relying on other sources of data. It brings up several issues. To address this concept, on this slide, I want to be clear that as is very well known, the 10K is the #1 communication channel for investment information or material information. 10Ks are corporate disclosures designed for investors and use in investment analysis. So what happens when we are lacking quality or standardization in 10K disclosures and investors or analysts look to other sources of information is using sources that are intended for a multitude of stakeholders, general community reporting or reporting to employees or regulators, and these various other types of reporting channels that lack the high quality, the potential for standardization, and the reliability that is seen and associated with 10K disclosures. To be a little bit more specific on that, we'll talk about SASB's view on CSR or voluntary sustainability reports specifically. Here we think it's very fair to say that the voluntary sustainability reports lack a true and fair representation of performance. One data point that helps support this assertion is a 2013 study that found that of some of the most highly rated sustainability reports, about 90% of the significant negative social or environmental events were not even included in these reports. So this begs the question of how can investors and analysts truly rely on these sources of information that fall outside of the standardized, commonly accepted channels for corporate and investor communication, such as the 10K, if these other types of channels lack this true and fair representation of performance. As we heard MSCI discuss, these are some critical issues, carbon and renewables in this industry. Yeah, I think that it's fair that over the medium term, over the long term, that this type of information that investors must look to high quality channels for disclosure, namely the 10K. With that said, I want to move into the second topic where we will take a very brief look at the state of disclosure. This topic that is included in the SASB standards is called end-use efficiency and demand. And the issue revolves around how electric utilities are positioning their business model to evolve in an environment with increasing needs for reductions in greenhouse gas emissions, increasing use of renewables, and increasing opportunities for managing these issues overall. And so once again, the current state of disclosure, I think, reaffirms the importance of this issue. There's disclosure provided in 10Ks on this issue 90% of the time, and 70% of the time there are actual performance metrics that are disclosed. However, the issue of the variation in metrics used to communicate company performance becomes that much more apparent with this issue. And to demonstrate this, we'll take a quick look at the wide variety of metrics that are disclosed in actual 10Ks by companies in the industry. Now, we're not going to walk through these metrics, but I think it's important to note that all of these metrics get at the same general themes covered by this issue. For example, deployment of smart meters or use of the smart grid, perhaps energy efficiency performance targets, or rate structures and rate mechanisms that allow utilities to benefit from energy efficiency gains. So all really important issues, kind of again as reaffirmed by how most companies are already providing disclosure on this issue. But again, what we're seeing is that there's a wide variety of how this information is actually communicated to investors. And I think, just taking a step back, I think this is unsurprising. It's not a job of any individual public company or the industry to form a consensus on the most useful metrics that all companies should move in the direction of. This is something that investors have a great need for and great demands for. And I think it's really outside of the scope of an individual company or individual industry to really play this role. So with that said, I'd like to talk about this environment, this corporate disclosure landscape on material ESG issues in a bit more of a macro sense. Looking at this wide variation in metrics and sometimes boilerplate or highly qualitative types of disclosures, this is our view on the current state of reporting. There's a lack of a common language or standardization for companies and investors to communicate performance on material ESG issues. Just a couple of quick data points that I think further back this up. This provides insight into investor views on the level of adequacy of current ESG disclosures, where the vast majority are dissatisfied. Over 80% are dissatisfied with how risks and opportunities are identified and quantified in financial terms. Nearly 80% are dissatisfied with the comparability, and close to 70% are dissatisfied with the key performance indicators. So that provides just a quick view on investors, I think, reaffirming that the current ESG reporting landscape is lacking usefulness for investment analysis. Looking at this very briefly from the corporate perspective, we talk to companies all the time that receive literally hundreds of ESG surveys, data verification requests, and other channels outside of the well-established 10K, for example, for investors to try to obtain this type of information. This can create an enormous burden on companies to comply with these types of requests. And instead of just looking at the electric utilities industry, this slide provides an overall analysis of the 10K disclosures within the SASB standards. And what we find is, once again, companies are already disclosing on these key sustainability issues 75% of the time, but over on the dark right, or on the right with the dark shade of gray, only 13% of the time actual quantitative performance metrics are used. Up at the top within the electric utilities industry, as we saw, that's significantly higher. But even, once again, as we saw, when specific performance metrics are used, there are significant challenges that greatly limit the usefulness of this information in investment analysis. As a result, SASB sees a need to establish a common language for companies and investors to communicate on material sustainability information. the types of issues that are financially material, provide disclosures that are decision useful and cost effective for companies to use. We'll look at SASB overall as an organization. We are an independent 501c3 nonprofit. We are developing sustainability accounting standards to establish this common language on an industry-specific basis. So we've thus far released provisional standards for all 79 industries in the economy. This slide provides a view of SASB's leadership team or board of directors, and I think the point here is that this vision or this need for a standardized language for companies and investors to communicate is backed by some of the largest names in the U.S. capital markets, with Michael Bloomberg as our chair, Mary Shapiro as our vice chair, other SEC former commissioners, and a former SASB chairman, for example, that also recognize this need for the establishment of a common language on material ESG issues. With that said, I want to establish clarity that when I'm using the term material and the way in which the SASB standards use the term material, we are using it according to the U.S. Supreme Court definition. This is the definition that is used by the SEC and thus is embedded in 10K reporting. As a result, to provide more clarity, what our view is the appropriate place for these disclosures and the use of SASB's standards is in the 10K. SASB provides these accounting standards in a format that's analogous to the SASB, in that we are not reinventing a disclosure process. We are simply accounting standards to the marketplace for integration into the 10K reporting. A bit more clarity on the actual standards, and that they include disclosure topics for each industry, the specific metrics, and technical protocol to help standardize the methodology used for each metric. This is a quick example of the migration from boilerplate disclosure over on the left. This specifically focuses on water management through what is more useful disclosure in the middle, but still not truly decision useful types of disclosures to the SASB metrics on the right. Very quickly, just touching on SASB's process, and that for every industry, all 79, we've spent over a year developing the provisional standards. In aggregate, each set of industry standards has on average only 5 disclosure topics and 13 metrics. We are focused on only providing focusing on the minimum set of sustainability information within our standards. I'm not going to spend much time on this, but I think it's logical at this point to take a big step back and see if what we're doing, if SASB's approach makes sense. And this was a great research paper that came out of Harvard Business School that used SASB standards to separate out corporate performance on material ESG issues versus immaterial ESG issues. I'm not going to walk through the results, but they're well worth reviewing in your own time. They really help provide a great data point that demonstrates that the capital markets are failing to efficiently process material sustainability information right now. And really the solution for this is standardization of ESG disclosures. SASB, on our website, we have an enormous amount of resources available. I would encourage a review of resources that are free and publicly available. And lastly, we work closely with a number of partners. These are some examples of our advisory partners that can help companies in considering and implementing the SASB standards. And with that, I'll turn it back over to Humani.
Thank you, Brian. That was a really interesting discussion as well. I have several questions that have come in already, and I'll be reading them out and directing them to Guillaume and Brian. Just to note again that this webinar is recorded, and we'll be sending out these slides and the recording to you after the webinar. And just to kick things off, though, I'll start with a question for Guillaume. So Guillaume, as Brian just discussed the need for and the benefits of standardization and reporting, can you provide your views on this? Do you think that your analysis would be more valuable or would benefit from greater standardization and consistency in the data available and so on?
Yeah, that's a very good question. So one of the things that we do look for is aggregation of data at the parent level. So the fact that you have companies that will report some data in the 10K and other data in their GRI compliance sustainability report or on their environmental reports, and also sometimes on the investor fact books, it does become sometimes a little bit challenging to reconcile all of the information. So having standardized data that could all be under one umbrella, in this case will be the parent level, definitely we would see some benefit in that.
Great, thank you. And we have a question that also relates to another question I have for you, which is, what challenges do you face as an analyst in collecting the data? How do you go about collecting the data? The question from actually the audience is that if even the best CSRs omit negative environmental and social information, how does MSCI obtain such information for ratings? So just can you talk a bit more about your process for collecting this information?
Sure. So we use a variety of sources. As I said before, half of our model is not dependent on ESG data disclosure. So we will definitely look into financial disclosure. So 10K would be, our primary sources for financial information. However, we do look at other corporate disclosure materials, sustainability report, investor fact book, investor relations presentation, GRI compliant sustainability reports. But one thing that's important to look at is when we assess exposure, say, of a company in a particular country, the data sources that we use are usually based on government sources. It could be sources provided by financial data aggregators as well that we can use. So it's really kind of like a plethora of sources that we use to come up with our ratings. But in all fairness, of course, there's a significant amount of data that we will collect based on corporate disclosure.
Thank you. Brian, anything to add to that in terms of when you do your analysis of ESG issues, what type of information do you look at given this poor standardization of this information currently?
Yeah, thanks, Swani. In SASB's standard setting process, we focus on anywhere where this information resides. So similar response to what Guillaume provided. However, we really like to focus on the established investment channels designed for disclosure of investment information, so namely the 10K. I think that this is helpful for our standard setting process as it provides a view of management's belief of the importance of these types of issues.
Thank you. We have a question coming in around the story told to investors and how that differs from the one for consumers. Do you see any difference in those? And this is a question for both of you.
If I could just jump in first on that, it is unsurprising that a story should differ for different audiences. Different audiences, different types of stakeholders have different needs, different issues they're interested in. To simplify things, investors are interested in financial materiality. As a result, the story, if you will, that a 10K tells is going to be fundamentally different than the story that is told to other types of stakeholders. So when SASB talks about using ESG information in investment analysis, we will continually point to that channel that is used to communicate financially material information, or the 10K. Guillaume, if you have anything to add on that, that's more than welcome.
Sure. Well, I think one thing to understand also is that a lot of companies are becoming more and more focused on integrating their financial and non-financial information. So I would agree that, if you look at disclosure in the 10K, it probably will be more, focused on what investors would consider as material. But if you look at the best performance that is in terms of sustainability disclosure, a lot of it will be integrated with their financial disclosure. So I do agree that sometimes the messaging could be different if you talk to an audience that would be focused more, say, on biodiversity than an audience that would be focused more on economic or, sustained profitability. But at the same time, as we move towards more and more integrated reporting, the messaging will cater to all of the audience together, focusing, of course, on what's most material for the company.
Thank you. So a related question to integrated reporting, so Brian, maybe this one for you. Is SASB supporting integrated reporting in the context of an annual report rather than the 10K form?
Yeah, it's a great question. So SASB does work with IIRC, for example, as we do recognize that this is where the markets are headed in the long term. And I agree with Guillaume's comments that, one, this is the direction that companies are already moving on. And I think that it's a logical place for these types of non-financial information to be integrated in financial reporting over the long term. So that's something that SASB does see as occurring and does agree with the movement in that direction.
Thank you. Yeah, and just to add to that, the 10K is the destination for material information in the U.S. Markets and the U.S. equities markets. So that's our focus in the near term, at least. There's also a lot of international interest in what we're doing with the European Directive, for example, for integrating or reporting on the sustainability information. So just to say that there is wide application of SASB also beyond the US 10K reporting market. All right, we have several questions coming in, so I apologize in advance if we can't get through all of them. But also you can feel free to email us afterwards for any further clarification questions. So maybe taking another question, and this one specific on, let's take the example of the electric utilities industry. So the question is there any convergence or divergence between MSCI's key issues and SASB metrics? And how does one reconcile any differences? So either of you can go ahead. Maybe Guillaume, you want to take a first go at that?
Sure. Well, as we saw from my presentation and the type of issues that we look at in the utility sector, as well as what Brian presented, there is overlap in the issues that we look at. So I wouldn't say that there's significant differences. I think if there is a difference is that our model will contextualize the data in a way that's scalable for investors to make investment decisions. However, from a purely perspective of what kind of issues we look at as having potential material impact and of course the disclosure topics and accounting metrics that SASB looks at, we can say that there is overlap in this case, yes.
I absolutely agree with that, and I would encourage anyone that's interested in that overlap to follow up by reviewing the slides, which did articulate MSCI's key issues they focus on and the key that included in the SASB standards. An enormous amount of overlap, which really should be unsurprising. MSCI is providing their research and insights for the investment community. SASB is developing our standards for the investment community.
Thank you.
Yeah, and one thing that I would like to add as well in terms of the overlap is that SASB, and MSCI have been working together to provide comments on disclosure topic and accounting metrics, and so we do collaborate in that fashion. In fact, in Q2, MSCI provided feedback on a set of industries, that includes the utility sector, and we do have this commitment to provide feedback on industry disclosure topics and accounting metrics.
Great, thank you. All right, so another question coming in is the reporting of metrics can lack context. So if a company above or below or within the competitive range on a given topic, what is their direction of progress over the last few years? A static table can lack meaning without the context of peers and trends. So I guess it's not really a question, but a statement that you need context around the data that is revealed through this. So any comments, Brian, on the context?
I'll comment.
Go ahead, Ryan.
I'll comment very quickly on SASB's how this topic is integrated into the SASB standards, and Guillaume, I'll let you comment from your perspective on MSCI's research as well. In terms of the SASB standards, they are not exclusively quantitative performance metrics, as I discussed in the presentation, a lot of the time, almost always, it's the surrounding context, perfectly consistent with the question, that really helps explain the quantitative performance metrics and really enables investors to derive insights and make use out of this information. As a result, incorporated in the SASB standards are structured discussions, or a discussion and analysis metrics, if you will, that provide guidance around a structured management discussion for discussing a specific issue, specific metrics, and doing exactly this, providing context for the quantitative performance indicators. Guillaume?
Yeah, Brian, so I agree with that. I think context is essential when it comes to financial data. When you look at financial data, there is context, of course, but it's kind of more robotic. You know, there's standards that are already well established. And when it comes to ESG, the importance of putting this data into context through a framework of analysis that would enable investors to understand how these, how the data that is derived from ESG issues actually impact companies is crucial, and that's what we aim to do via our ESG ratings model.
Thank you both. So for Guillaume and Brian, actually, are you seeing demand for this type of ESG information increasing, particularly from investors?
Sure, I can comment on that. We've definitely seen some demand for that. That's been increasing significantly. We've been moving more and more from a screening-based approach to a fundamental integration approach of ESG factors and analysis by mainstream investors, and we see this as becoming more and more sophisticated and varied. We do also note a growing interest in understanding long-term investment decisions and the role that ESG factors play in that process. So definitely we've seen more and more demand coming forward, and I think examples like the Volkswagen scandal, the BP scandal are good cases of investors showing more and more interest in understanding ESG data, ESG factors, and also coming up with a process that would be more preventive compared to reactive, right? So a lot of the times ESG become, important after the fact. So the idea that we're seeing now is more and more investors being interested in factoring in those information or the data beforehand, so that they can see how this could impact their own valuation of the company.
Completely agree with your comments, Guillaume. I think there are a lot of data points to point to that help articulate this theme around growing investor interest and demands for this type of data, whether it's funds under management that are using ESG or integrating ESG, or whether it's usage of ESG data on the Bloomberg terminal, for example. Just a bit more anecdotally speaking, there's an enormous amount of excitement that we here at SASB get to see every single day from the investment community around the potential for a standardized language for companies and investors to communicate on material issues. So absolutely a lot of excitement out there and a lot of growth to be had.
Thank you. And Guillaume, this one's for you. So how does MSCI view SASB's reporting standards as relevant and useful for investors compared with GRI G4?
Well, I can start by talking about, GRI G4. I think that one thing that was maybe confusing to investors is that we started with G3 and then G4, and then now we have integrated reporting. There's a lot of sometimes confusion on the part of investors in trying to understand, well, what is the right standard, and for companies also it's a burden, right? Because they have to constantly adjust their own reporting, and then they have to manage resources appropriately. So that becomes sometimes a problem. In terms of MSCI's position with respect to SASB, our position is that we do support SASB's efforts to create greater transparency and consistency in the disclosure of ESG data. However, I'd like to point out that at this time, MSCI does not have plans to formally incorporate SASB metrics into our ratings. We do have an internal process to review and account for differences in terms of what constitutes, ESG material issues. So we are basically working constantly and tracking, relevant topics that would be derived from ESG megatrends. But in all, at this point, we would be supporting greater transparency, greater integration of data, but not necessarily, as I mentioned, the incorporation of metrics in our ratings, like the SASB's metrics in our ratings, that is.
Thank you. Brian, for you, is SASB advocating that their standards should be mandatory for companies who disclose material sustainability metrics in their 10Ks?
No, SASB's view is that the current requirements for corporate reporting are appropriate as they are, and that they, generally speaking, already require the disclosure of material information as appropriate. Therefore, SASB encourages the corporate community to look to the SASB standards really as an opportunity or as a tool to use to communicate performance or these types of material information to their investors. We think, and we have a lot of great feedback, whether it's from securities attorneys or the corporate community or accountants, that this can be a really effective tool for companies to use to satisfy the existing materiality requirements in 10K reporting as is.
With that in mind, can you both speak to the importance of a targeted set of topics and metrics and why that is important? And maybe you can take an example, or the example of the electric utilities industry. We see in sustainability reporting with a lot of different frameworks, there is a lot of different metrics and topics that companies could choose from, investors could look at. What is the importance of targeted material information?
Sure, I completely agree with you. Specifically with the electric utilities industry, a lot of issues, a lot of potential ESG or sustainability issues. It's similar with other industries, probably even more so with this one. I think that continually coming back to the theme of financial materiality. So in looking at any one specific ESG issue, really approaching that issue with a need to understand, does that issue have the potential to financially impact the company in a very meaningful way? Does it really relate to financial risks and opportunities? So SASB's response to that topic or that question will always come back to financial materiality. And when we really drill down, when we really hold the standards and the standards development process to a very high bar or high level of discipline in order to include any one ESG topic into the standards, we find that in any one industry, it's usually a relatively small number of issues that really do have this potential for material impacts. As I said earlier, across all 79 industries, our standards average only 5 topics per industry, which I think reaffirms the need or the discipline in the standards of focusing on those issues that are most likely to be material from a financial perspective.
Thank you. And I guess that's seen in also the Harvard study, which shows outperformance for companies that focus on these material factors over immaterial factors. There's a question around the timeline. Sorry, go ahead, Guillaume.
Yeah, I was just going to add that the one benefit of looking at it from a purely financial standpoint may sometimes skew the value of looking at a metric or a topic that does not have a financial component to it, but that otherwise would result in financial consequences. So there's specifically talking about the utility sector, regulated utilities are sometimes viewed as somehow sheltered from any form of ESG risk when it comes to cost, right? Because they can pass on cost to customers given their regulatory status. So sometimes we would tend to look at some of the metrics as kind of being non-financial. But there's been some cases recently. I think the Southern Kemper plant is a good example, whereby the Mississippi Supreme Court canceled well, ordered the utility to refund some of its customers for costs that were passed on, and so that had a direct impact on the utility, and that was a result of cost overruns for a power plant, right, that had a ESG benefit, which was clean coal. So what I'm trying to say is that it's important to look at it from a financial perspective, but also having a framework that allows, to put that issue into context so that an investor can potentially look at the preventive aspect of what potential costs, a company could incur.
So we're close to time now. I just wanted to end with one final question, maybe you can address very quickly. Is the quality of sustainability metrics are currently not as robust as financial metrics and often need to be viewed over several years rather than quarters that financial metrics are currently viewed in. How do you reconcile this difference to accommodate more integrated reporting? Are the SASB metrics intended to be used in annual reports versus quarterly financial disclosures?
Yeah, it's a great question. We have guidance in the SASB standards that essentially recommends 3 years of data or disclosure of the prior 3 years. I think that disclosure on quarterly performance, for some of the most significant issues or volatile issues, is a potentially, value-adding long-term initiative, but that's not fundamentally where we are right now. SASB's focus is on annual performance, and we're staying focused on really our core objective, which is standardization of annual performance. I'm happy to elaborate on anything there, or happy to let Guillaume respond. But I think that overall we have a little ways to go still. And that we're really focused on the core objective of the SASB standards for the foreseeable future.
No, I agree that annual performance is important, but some of the things that we've been seeing recently is that ESG events could have an impact on a quarterly basis. And one of the things that we do is constantly scan, the market and scan corporate events that would impact the companies that we cover, and we would then adjust our ESG signal accordingly. So it's important for data to be consistent across the years. We do look at sometimes 3-year average or 5-year average, but we do want to stress out that if there is a material ESG event that impacts the company's financially, or that would have a change in the company's exposure to a particular risk or opportunity, MSCI has a process to answer to those events, adjust the rating accordingly.
Well, thank you both. It's been a really enjoyable webinar for me at least, and hope everyone enjoyed it as well. We will be sending the recorded webinar as well as the slides by email following this. And please feel free to reach out to us if you have any questions. And with that, thank you everyone for joining.
Thank you.
Thank you.